Hello everyone, welcome to Atomic ACCA's exam solving series. Let's move on to the remaining part of Audit and Assurance pre-mock exam for June 2025 session. So we're done with section A, we're done with the easy reading parts and scoring parts. Now we have the long questions, the box question and substantive procedures remaining from each of this. So what we can do, let's go back to our beginning of section B and let's start with the question number 1 we have here. This was inherent risk that we are already done with. Next is audit risk. So this is a general question. We have 8 audit risks, so that's going to be for 16 marks and explain the audit response. So okay, very straightforward it is. Now we have to use all the tricks that we have learned back in the class and start doing this one. So we have 1 mark, zero point 0.5 mark for the identification part, zero point 0.5 mark for the explanation part, and we are going to get 1 mark for the response part. So it is 1st July 20x5. You are the audit supervisor of Glad and Company and are planning the audit of We Buy Company for the year ending 30th September 20x5. So you're in the audit planning stage. We Buy is an online retailer of luxury bags and watches from leading brands sourced from all over the world. The forecasted profit before tax for year ending is 23.4 million. Since this is the first time your firm is auditing We Buy. First time auditing We Buy. That means new client, detection risk. Planning meeting with finance director was detailed. Notes have been summarized below. Okay. We Buy Company is a new audit client. Is a new audit client. What is the problem over here? As what is our company's name? As Glad and Company has not previously audited this client, they may be unaware of the regular uh, reporting frameworks, management integrity, opening balances, and previous history about the client. Just make this a little small. About the client, about the client. Hence, there is a risk of detection for the auditors. Now, what can auditor do over here? Glad and Glad and Co, right? Yeah, Glad and Co can spend sufficient amount of time in audit planning and understanding the nature of business and operations client is involved in. They must assign a suitable competent team to audit this client. Then auditors must maintain professional skepticism throughout the audit. So they should spend sufficient amount of time to understand the nature and business. They might assign a suitable competent team for this audit, and they must maintain professional skepticism. Fine. So we got 2 marks over there. Next thing, what few things you can always look out for audit risk questions: negative wordings or two positive wordings or dollar sign amount. Whenever these things are there, some of the other audit risk you can figure out of this. Hopefully from every places. 99% you can do it. Sometimes you may not be able to do it, but that depends. For example, here dollar sign is there, but don't try creating any audit risk over here. There's no audit risk. That is just the total of the profit figure. Cool. So although company only sells through website, it has a network of 3 warehouses in different cities to reduce shipping cost. Company's management has recently introduced a director's bonus scheme to further incentivize growth in profit. Directors' bonuses were previously fixed. However, from this year onwards, the director will be paid a bonus based on gross profit growth. So, what happens when gross profit growth is there? They will get more bonus. Chances are they are going to overstate the income, understate the expenses. So, we're going to copy paste. Directors will be paid a payment based on growth. Directors will be paid a bonus based on gross profit growth. As directors, this means that there is a risk auditors sorry risk that risk directors may try to overstate the revenue figures or understate the cost of sales. Now this that was a very one liner statement, so I can increase it a little bit. How can they try understating cost of sale? Because this is specifically about gross profit growth. They don't really care about what's happening with operating profit. So what they can do is whatever is in cost of sale, they can put it under operating expenses. What is cost of sales generally called as direct expenses? What is operating expenses called as indirect expenses? So company may try doing this by classifying the direct expenses under indirect expenses. This understatement of cost of sales may be achieved by classifying direct expenses under indirect expenses. So that is the risk over here. Now, what can auditors do over here? Auditors need to maintain their professional skepticism throughout the audit, considering the risk. You don't have to say that. Auditors need to increase their substantive testing around revenue and direct expenses and provide enough time during the audit around this region assign competent audit staff to do audit around revenue and direct expenses. So that's enough. Next, Vbuy's payroll processing had always been outsourced to PM Limited, but recently the management was not satisfied with the performance of the service provider and therefore cancelled the contract in early June 20x5. When was the year end? 1st July 20x5. And when did they cancel it? Early June 20x5. That means from year beginning till early June 20x5, PM Limited was dealing with the payroll part. And after that, only that last one month, if they're canceling the contract, means WeBuy will be doing it themselves. That means for the payroll figures over all those months, there are chances that because not satisfied with the performance of their service, means probably PM is not having proper internal control, or there could be a lot of wrong accounting or wrong records that is being done, or some other problems could be there. So whatever it is, there is a chance that there are misstatements in the payroll figures for all those months where PM was dealing with the payroll part. So we can bring that point up over here. That statement is too big, so we can just make it small. WeBuy cancelled the contract with PM Limited, external payroll service provider, in the early June due to poor performance. Now, what is the risk over here? As the contract was only cancelled by early June, there is a by early June, their poor performance may have caused as the contract was only cancelled by early June, all payroll figures in financial statement over the year have been processed from their end. Hence, due to lack due to poor performance as mentioned, there is a chance that high amount of misstatements may be included within the payroll figures. Now what can I do? um, Audit team must do detailed audit testing for payroll figures up to documents available, as this will be limited due to payroll operations being done by external provider. What else can they do? Increase detailed audit testing should be done. Okay, that is okay. What else can you do to understand a little more about the chances that misstatements could be low? You can understand how the controls were maintained in their company. How you can do that? You can obtain a type 1 or type 2 report by getting in touch with their auditors. So Glad and company may try contacting the auditors of what is it, PM Limited. And company try contacting the auditors of PM Limited and obtain type 1 or type 2 report about the internal controls maintained at PM Limited and conduct a review of it to understand the appropriateness of controls maintained there. PM Limited. Okay. So that is enough. Then PM had been responsible for processing and making payroll details and maintaining employee records. Two of Webui's accounts clerks were trained within a week and given the task of maintenance of employee records and processing payroll in mid-June 20x5. Now that is another risk over here, that because they were trained only within a week, that is in the last 2 weeks or that last 1 month, because of that short time period training, there are high chances that these employees may not be trained enough, and again chances of high misstatements in payroll figures with it. So what can auditors do with regards to this particular figure? Auditors can obtain documents or increase detailed testing around this last 1 month, because all documents now it will not be limited because the company staff is doing it. So during the last few months and also in the early beginning years, auditors must do the increased testing around this area, even with the cutoff testing, because they might record it in the wrong time period. All this could be happening. So auditors can do improved or detailed testing of all things at the year end plus post year end as well for the payroll records. So two of the accounts clerk were in given maintenance of this one. Okay. May, June. Okay. As the clerks were only trained for a term, short term, due to lack of training, there may be a chance that payroll records could be maintained and processed wrongly. Hence, leading to over or understatement of payroll figures. What can the auditor do? Auditor may increase the test auditor may detailed increase detailed testing of payroll expenses around the year end and post year end to confirm the accuracy of figures recorded, as well as the controls maintained by, what is the company's name? By M. No, V by. As the controls maintained by V by company. What else to do? Anything else? Maybe you can get an understanding of what kind of training was given to them, just to get an understanding. Discuss with management. Discuss with management the nature of training provided to the clerks. Assess its appropriateness, and also get an understanding of their future plans with recording and maintenance of payroll payroll. That's enough, because they have discontinued the contract with the pay M company. What is your future plans? I'm getting just an understanding of that. All right, so we're done with this one. How many we are done? We're done with 1, 2, 3, 4 points. Okay. The initial analytical analysis of the information yielded the following results. Revenue growth is estimated to increase from 5 to 16% in a year. So that is one indicator that from the previous one we had. Where is it? We can maybe add the point over here. Here we told about the classification part. Auditors need to increase their substantive test around revenue and direct expense and provide enough time during the audit on this region. Okay, we'll just one point came up from this word just right now about the classification. When I read, we can just add one more point over here. Auditors may also do a detailed test of classification of the expenses included in what is that, direct and indirect expenses. Okay, so what is given over here? Revenue growth is estimated to increase from 5 to 16% in a year, while gross margin will increase from 26 to 32% in the year. Okay. The operating margin, however, is predicted to drop from 19 to 12%. So this is like an indicator over here already that these things, whatever we mentioned, are almost going right, because all these gross margin is increasing but operating margin is decreasing. So possibly there is a chance that they tried overstating the revenue, put the direct expenses under indirect expenses. So I can just add this point over here to get a little additional push to my answer. This can be understood from the analytical procedures done where revenue and gross profit margins are increasing from 5% to 16% and 26 percentage to 32 percentage respectively, while the operating margin is dropping from 19% to 12 percentage. So that was just a point to support my answer over there. We got that analytical procedure. Cool. So let's go forward. WeBuy's internal IT team developed its own mobile phone application for 4.8 million for selling luxury products through the application. Mobile phone application means it's an intangible asset, so you can capitalize this. If this is a research and development thing, so you have to bring all that R&D knowledge. The mobile phone application will increase the ease with which customers book orders, and it's estimated to increase visitors on the platform. WeBuy has capitalized the entire amount, which includes 1.1 million spent on legal fee for registering the application with the regulator and training employees on how to use the application for sales processing. Legal fee is something that you can capitalize, but training employees you can't capitalize. So out of 1.1 million, some amount you have to pull it out. So considering now training employees is capitalized, this is a sure mistake. So when it's a sure mistake, you have to word it accordingly. This is not maybe overstatement and maybe understatement. This is sure overstated, sure understated. Okay. Application is being tested and is expected to be rolled out to customers soon. Considering that it's not rolled out to customers soon, they didn't start generating any revenue yet, which means no amortization is to be recorded. Okay, so we can just write over here. WeBuy has capitalized uh, the entire 4.8 million, the entire dollar 4.8 million invested into developing mobile application, of which dollar 1.1 million relates to legal fee and training employees. Whenever you think that this copy paste thing will lead to almost like, let's say, information is spread out through the entire paragraph, then don't copy paste this entire paragraph over there. Rather, just reword it accordingly and simply indicate what you're talking about. So in 3 lines, just a small one sentence, we explain this whole paragraph. This is what you have to do. Don't copy paste the entire paragraph over there. Cool. Now, so what is the problem over here? As per IS 37, no, IS 37 is provision. IS 38 is for intangible asset. But if in case you don't know the accounting standard, just like how I messed it up, if you don't know the accounting standard, just say as per accounting standards related to intangible assets, expenses related to research phase are to be expensed to SOPL, while those meeting capitalization criteria must only be capitalized to SOFP. Here, the legal costs may be capitalized, but the training or costs are to be expensed out. Hence, the intangible assets are overstated and expenses understated. So we're not telling it's maybe chance, it is for sure, because they told that out of the capitalized amount, training employees is there. So it is capitalized, which is wrong. So discuss with management and understand their rationale behind recording training fee as a capital expense. Understand the rationale behind recording training fee as a capital expense, and also advise them about the correct accounting treatment as per IFRS. Now, only discussion is enough? No. If they have included training expense, which is only 1.1 million, now 4.8 million is the total figure. Now, this poses some slight indication that okay, if they have recorded something wrongly, maybe there could be chances out of that 4.8 million, something else could also be things that are not supposed to be capitalized. So, as an auditor, what I'm supposed to do? Obtain a breakdown of expenses capitalized or cost capitalized. Cost, cost, obtain a breakdown of cost capitalized within SOFP and confirm these figures meet, or these cost meet the capitalization criteria. All right, so this paragraph is done. How much we are done with? We're done with 1, 2, 3, 4, 5. We need 8, so we need 3 more. Okay, 3 more boxes are there. VBuy requires customers to make a deposit of 25% of the amount upon order confirmation, and the remaining amount is payable when goods are delivered. So 25% is like an advance income, but what is the accounting entry we have to do? Debit cash, credit revenue? No, credit deferred revenue. So it should go to liability. Then when the goods are delivered, from deferred revenue, we have to debit and clear it off, put it under credit revenue. Payable goods. Okay, VBuy also offers its customer the facility to return product within 10 days if they are dissatisfied with the product or think it is a fake item. So facility to return product, when you're selling goods with the right to return, what you have to do, for whatever goods that you're expecting that will not return, you can record a revenue. Whatever you're thinking it might come into a return, you should not book it as a revenue. You have to put a refund liability for it. This is all IFRS 15 rules, that 2 points over there. So we have two risks from the same paragraph around IFRS 15. So we found two over here. So from the remaining paragraphs, it's only one we have to find out. So let's write. VBuy requires customers to make a 25% deposit upon order and remaining is payable. Okay, this is like a one small sentence, so I don't have to rephrase it myself. You can just use this. Now, what is the problem here? As per IFRS 15, advanced receipts are to be recorded as deferred revenue until the performance obligations are satisfied. Hence, there is a risk that client may record this 25% deposit as revenue before delivering the goods, causing revenue to be causing a risk of overstatement in revenue and understatement of is it expenses? No, understatement of liability, because this deferred revenue is something that goes to liability part. So understatement of liability. Now what, as an auditor, I have to do? For a sample of deposits that you have received, confirm that these figures are included within the refund liability, not refund liability, under the deferred income section. Or you can discuss with the management and understand if they know about the accounting treatment properly as per IFRS 15. Then obtain the breakdown of deferred income recorded within SOFP, or obtain a breakdown of the 25% deposit that you have received. And for all goods that are not delivered yet, confirm that these figures are there within deferred revenue. So this is enough. So first thing, discuss with management and an understanding about their awareness of the accounting policy as per IFRS 15 and the practice they are following, because I don't know if they're accounting for it correctly or not. Secondly, for a sample of deposits received but goods not delivered yet, for a sample of sales orders where deposits received but goods not delivered yet, confirm that these amounts are included within deferred revenue in liability section and not as revenue in SOPL. All right, how do I get this up? I can't take it up. Okay, cool. What was the second issue we told about the refund liability? As per IFRS 15, if you don't know IFRS 15, just say that as per the accounting standards related to revenue. What if you don't know anything about this refund policy or return liability stuff? Then you can't do anything because that is specific accounting standard from IFRS 15. So if you don't know, then you can't bluff any information. You'll have to find information from the next paragraph. So as per IFRS 15, when sales are made with a right to return, seller is supposed to record revenue only up to the limit where they are sure goods will not be returned. For the chance of return, the amount is to be recorded as a liability, as a refund liability in SOFP until 10 days, because 10 days is the time period. So until 10 days after sale. Cool. As per IFRS 15, for chance of return, the amount is to be recorded as a refund liability of in liability in liability in SOFP until 10 days after sale based on V buys policy. So what is the risk over here? Now we told about the accounting standard and what is to be done. Hence, there is a risk that we buy may record the entire amount as revenue without considering the refund liability, causing a risk of overstatement in revenue and understatement of liability. Okay. Now, what does an auditor I can do in this situation? I have to confirm how they are calculating the refund liability. I also want to know, I can discuss the same thing with them if they know about the refund liability accounting. So discuss with management and obtain an understanding about their awareness of accounting policy as per IFRS 15 in practice they are following with regards to refund liabilities. This is just to understand their thing, but I'm not going to simply understand their thing and sit over there silently. I want to see how they have accounted for it. So what will I do? I want to see for goods that they have sold, they are offering customers the facility. So probably it's for every sale. So for every sale that has not passed beyond 10 days, or for a sample of sales orders that have been for a sample of sales orders, uh, obtain a breakdown of the amount of revenue they have recorded and the refund liability they have recorded, confirm that or obtain an understanding of how they have come across this refund liability figures, and confirm that these are in accordance with or these are somewhere in line with the previous refund liabilities they have recorded in the past. If in case there are significant differences with the refund liability recorded in the past and now, discuss that with management. Okay. For a sample of sales orders, uh, for a sample of sales orders, this is return the product within 10 days if they're okay. Okay, they didn't tell. Okay, whatever. For a sample of sales orders, uh, obtain the amount recorded. Wait, for a sample of sales orders, confirm that an amount is recorded within refund liability. Discuss with management. No, refund liability. Obtain an understanding of how this refund liability has been calculated. Compare this with prior year records, and where significant differences arise in refund liability for for a similar product sold in both years, discuss with discuss with management. So what we told here, obtain an understanding of how this refund liability has been calculated, then compare this with prior year records and where significant differences are arising in the refund liability for a similar product that is sold in both years. Last year also you sold this thing, this year also you sold this thing, but the refund liability recorded is way too different for both of this. Then discuss with the management where significant discrepancies are arising. Cool. So now we are done with 7. We just need one more thing. We have two paragraphs to find this from. All right. VBI has recently faced increased criticism from local tax authority for underpayment during the year amounting 2.56 million. This one we dealt earlier when we did that other question regarding the amendment required in IAS 10. So we have already discussed what accounting treatment and things are to be done. We can just mention the same thing over here. So investigation by tax authority are ongoing. The decision is not anticipated until the year end. However, tax consultants have expressed concern that this amount will probably have to be paid. Now, since we discussed this already, the point will basically be that uh, initially we're going to just mention about this tax authorities investigation going on and this underpayment of 2.56 million. Then after that, we will write the risk over there that there is a risk that the auditor, I mean, sorry, there is a risk that the client may have not recorded this 2.56 million as a provision. Okay, we don't know because that other point was they are getting a notice post year end. That's why it was an adjusting event and things and all. But until this point, we don't know whether that notice is coming or not. So over here, we should not take that information and write here. We should write only information till this point, whatever is available to us. So based on that, we can say that there is a risk that this 2.56 million, which is an understatement, have not been recorded as a liability or a provision as per IAS 37. Or you can say the IAS 37 rules also saying that as per IAS 37, if the provision is of a probable or virtually certain chance, provision is to be recorded as a liability. If it's only a possible chance to be recorded, it can, I mean, to be paid, it can be recorded only as a disclosure note. No need to record as a liability. Now, here, what we will say, there is a chance that if it's a probable payment, they didn't mention anything about whether it's a disclosure or provision, nothing is mentioned. So you can say that if probability is high, there is a risk that provisions may not have been recorded, or if it's only a possible chance, there is a risk that disclosures may have not been done correctly. So there is a risk of misstatements in financial statement, understatement of liability, or missing information in the disclosure note. What we will say in the right side, in the right side box, we will tell that as discuss with management and discuss with the tax consultants what is the likeliness or what is the probability that this payment may have to be made, and based on the probability, if it's high probability, then confirm that this is included as a liability, or if it's only a possible chance, confirm that this is there in the disclosure note. Since this discussion we did already in the other question, I'm not writing that point because now I've discussed what points is to be written. Let's find an information from the last paragraph and write that because we have not discussed this earlier. Cool. So eBay offers a deal where slightly damaged luxury bags and watches are sold at extremely discounted prices to clear inventory after the year end. So damaged goods is an indicator that recoverable amount will fall. One more indicator is there, they are given at extremely discounted prices to clear the inventory. So probably the NRV would have gone below cost. This happens during the first 2 days of October after year end. That means at year end they might have recorded at the cost big figure, but post year end after first 2 days after that means post year end they're selling it at a low price. So what happens? NRV would have fallen. But as per adjusting events, if NRV has fallen right after the year end, you have to adjust it at the year end closing balance of that inventory. These deals are hugely successful with the sales volume drastically increasing in those 2 days. When is the year ending? 30th September 20x5. So first 2 days of October means right after the year end. So we're going to sell that. WeBuy offers a deal where slightly damaged luxury is sold after the year end. Okay. One statement it is, so I'm not just rearranging, I can just copy paste it. Now what are we going to write over here? We can say that if inventory is sold at extremely discounted prices which are damaged. This is an indicator that NRV may have fallen below cost. As per IAS 2, which is inventory accounting standard, as per IAS 2, if NRV is below cost, below cost, a write down is required. Hence, there is a risk that client may not have recorded the relevant write down, causing an understatement of expenses and overstatement of profits. And that overstatement of profit is not necessary to write over there. When you write understatement of expenses, it's already understood that profits will be overstated. Cool. Now, as an auditor, what can I do over here? How can I confirm if this NRV has fallen below cost? I can look at what price they are selling this, because they told that it is successfully selling after in those 2 days, which means there's definitely a lot of sales order coming in. So you can just collect some sample of sales invoices made post year end, confirm what is the amount over there, then you can find what is the NRV. Then for the same item, obtain the breakdown from inventory and confirm at what value is it recorded over there. Confirm that this NRV is greater than this cost, and if in cases NRV is below cost, confirm that whatever write down is recorded within SOPL. So let's frame that. For a sample of sales for these damaged goods made after year end, obtain the sales invoices to confirm NRV of these products. Now we confirmed the NRV. Should we simply confirm the NRV and sit quietly? No. For the same products, check for the same products, confirm that within inventory the recorded, for the same products, confirm that within inventory it is recorded at is recorded at the lower of cost and NRV, and if any write down was needed, confirm that write down is recorded as an expense within SOPL. So what did we do? For the same items, we are checking within the inventory if it's recorded at the lower of cost and NRV, and wherever if NRV is lower means write down is required. We're confirming that the write down is recorded as an expense in SOPL. So we're done with all the paragraphs. We're done with our 8 points that were required over here. Now, definitely, I tried finding one from each paragraph, and because I went all the way till last, I skipped this point over here. So, probably there was one more extra point, and something in between this could be there as well. If you go through the actual solution, you might find some more points. But yeah, we don't have to write anything extra. We have 8 points. We discussed 1 point over here, so we basically got 9 points. So, that is more than enough, and we are done with this question. So, we're done with a question that was what is it? Inherent risk, that knowledge based question. We're done with this audit risk question, and now we have this third question, and I think D question we finished earlier. Yeah, D1 and 2 we finished earlier. So this question was related to 4 requirements. So from case study number 1, we are just left with one more question, that's substantive procedures over here. What is the question asking? Describe substantive procedure. Where is it? Describe substantive procedures the auditor should perform to obtain sufficient and appropriate evidence in relation to research and development expenditure in development of mobile phone application. Cool. So research and development is a very common topic that you must have seen from your exam kit, and if you have not seen, very bad. So where is research and development? Over here. So what about research and development we can do? very common procedures are there. You just, how many marks this is? 5 marks. So you have to write 5 procedures. All right. So procedure number 1. First, whatever information is directly given over here, first we can connect to that and write information. Then whatever extra we need, we can do. So some information we already wrote in the audit response part. Same thing becomes the audit procedure also over here. What we can write? First thing, out of the 1.1 million uh, legal fees there, you can discuss with management and let them know that training employees are not to be capitalized and it should be expensed out. So you can inform them that. Okay. So discuss with management and obtain their rationale behind recording training fee as a capital expense. Inform them about the rules as per IAS 38 standards. Now, since that was the same information we used in the auditor response as well, we'll try finding 6. Okay, just to let you know that okay, we have more points to write. So that one we can, this one just for sake we have written. We'll write 5 new points over here. Okay, what 5 new points I can write? First thing, there is 4.8 million recorded within SOFP as an intangible asset. I want to know whether, first thing, whether this amount is correct or not. Okay, this 4.8 million, whether it's correct or not. So what I can do, for the amount recorded, no, obtain a breakdown of costs included within intangible assets, that is dollar 4.8 million. Agree to the related invoices and confirm that amount recorded is correct and accurate. So what we're doing, we're taking the breakdown, we're checking the invoices related to it and confirming, okay, this is 100,000, 100,000, 200,000, 200,000. So you're just confirming the amount is correct. Next thing, there could be many expenses over here. So many invoices are there. So I'm just going to total this up. There could be many invoices over here, figures over here. That breakdown also I'm going to total it up and confirm that the total over here in the invoices and the total over here is matching. So what we are doing, we are casting it, we are adding it up to confirm that figure, math accuracy in adding up as well. So for the breakdown obtained, cast the figures and confirm the total with invoice totals, with related invoice totals to confirm accuracy in figures. So we added up, found the total. Next thing, whether this amount is supposed to be there or not. This is the next thing I want to know. Now I've checked whether amount is correct. I've checked whether the addition is correct. Third thing, I want to know whether this is supposed to be recorded here or not. How do I know that? I want to obtain a breakdown and confirm that all the costs that have been recorded over here has met the capitalization criteria and none of it is related to research expense. Cool. So obtain a breakdown for the capitalized cost and confirm that all amounts, should I give a simple sentence like all amounts have met capitalization criteria? No, I already know that this training fee is not a capital expense which is there inside that, and that is already capitalized. So what I can say is obtain a breakdown for all capitalized costs and confirm that all amounts apart from the training fee, because training fee we made a separate point of discussion already. So apart from training fee, let's see what about the other figures. So obtain a breakdown of for the capitalized cost and confirm that all amounts apart from the training fee meets the capitalization criteria to be included within SOFP, and none of it is related to research expense. Similarly, we can work it in the opposite way as well. Now, capitalization part we discussed a lot. We can talk about the SOPL part. We can obtain a breakdown of all the research expenses put in SOPL and confirm that all these are research expenses and none of these meets the development criteria or the capitalization criteria, because then it should be in SOFP. So same point, we are now going to write the opposite way. Obtain a breakdown of research expenses in SOPL and confirm that all amount all amount meets the or confirm that all amounts are supposed to be included within SOPL and none of it is related to or none of it meets capitalization criteria. So that is also over. Now 1, 2, 3, 4, 5. We're done with 5, but we agreed that we're going to do one more extra point just for the sake of it. So one master point, just like the escape point we have from substantive procedure, that is to go and check the disclosure note. What we'll do, whatever intangible asset, R&D related disclosures are there, we're going to just obtain the disclosure note, check if it is relevant or not. This is like the final escape point from substantive procedure. You can use it like a tip always. So uh, review the disclosure notes and confirm that all disclosures related to research and development is in accordance with the requirements of IAS 38 and is adequate. Hello. So we're done with that extra one more point and we are done with 5 procedures for this one, and with that we're done with case study number 1, because fourth question we did earlier. So hope you have followed with how we have done the substantive procedure question and also most importantly the box question for audit risk. So hope this video has been helpful in figuring out or filtering out how we do our brainstorming with the audit risk questions and how we plan our answer and what amount of size also or what amount of content we include over there, and hope you have understood the difference between how we do deal with a doubtful situation means maybe a risk situation, which will be the most cases, and how we write and frame the sentence in case of sure mistakes where we told about that training charge being capitalized. So make sure to let us know through the comment section how this video has been helping in your or how it has helped in your preparation for the audit exam paper. See you soon in the next video. We are left with one more case study where we are having a lot of internal control related topics. And from the final case study, I think one small question we have remaining that probably we'll be doing in the next video. So see you soon.